and thanks for checking out my channel. I'm going to have a look at WTI crude oil tonight, looking for the week ahead and the plan that will be quite similar to what it's been for the past few weeks, but we might have some break through next week on that market. Let me go through this quickly and go quickly also through the fundamentals and some technicals and see where we go. Starting with the fundamentals, as we can see, my opinion, the fundamentals are now turning bearish. The first one, we're having the OPEC plus cohesion is cracking. As we can see, Saudis is basically taking almost all of the cut, while Russia and others, especially Asia, are actually pushing to also increase the output, but also from India asking for lower price in terms of the consumption. So that's definitely putting pressure on this. Should we see some more cracking inside that cohesion, we will see a quick collapse of the unity around keeping the production low. That could have quite some impact on the price in the short term. The other thing also is the vaccination hope around some traveling increasing a lot, air travel especially, but also on the road for holidays and everything is definitely at threat because of the resilience of the virus at the moment. That's unlikely to see economy opening up widely in the coming months, and it's probably losing that summer. That will be a big deal also for oil consumption. If we see, of course, the supply increasing in the same time, that could be a recipe for a significant move to the downside. We've also seen over the past few weeks, that's pretty much linked to the previous point, but the continuous build in inventory, so not so much on the crude inventory, but that one is, in my opinion, not that meaningful in terms of the demand. But the gasoline and distillates have been quite significant build in inventories over the past few weeks. That's pointing to a demand that is still actually struggling to cope with the supply. And finally, and very important in my opinion, the funds are very much exposed in terms of the long side. They have anticipated much higher price. Should they start seeing that it's not happening in the short term, they will have to unload the position, take profit, and that could have a detrimental impact on oil price. We can see here last week again in the court report, of course, in terms of the price, it was relatively flat, also moving from 61 from 258, so it was down. We could see the open interest was increasing. It's quite solid, but more important, we've seen that they reduced significantly the long exposure. They also reduced short and didn't start loading it, which is probably why the price didn't collapse much lower. And as we can see, retail traders are usually on the wrong side on oil. They've been loading up on the long position that could actually feed a breakdown below 57 should they actually start closing these positions and getting squeezed out. We can also see, very important, that the hedgers, they're actually reducing the short exposure as well. So they don't actually anticipate, despite the recent drop, continuation of the move, resuming of the price to move higher. Also very important, I think in that court report, that's almost more important than the managed money taking some profit off the table. Should we see that trend continuing, reduction of short position from the swap dealers, we can definitely start seeing some acceleration to the downside, as they will definitely start feeding all the various position. As we can see here in the summary on the court report, it's quite very high exposure from the managed money here, as it's sitting near 500,000 open position to the long side. So of course, with the start to reduce this, they still have a massive room to go down. They could approach zero. That's a huge amount of contract they will have to close. That could easily drop the price to 50, potentially even lower should they actually push it lower. So that's for the fundamentals. Now looking at the technicals, I think it's even worse than this. As we can see, we have a massive bear flag on the daily here. It's very obvious. The price has been very much struggling to actually break higher, has been rejected significantly with really large red candles, and also very important, we got death cross between the 20 and the 50 MA, which is not necessarily that meaningful most of the time. There's many wrong signals from that kind of death cross, but in that instance, and I've actually put together a few from the past we had. It is quite reliable. Of course, technically, and if we look closer, the cross didn't happen yet, so we'll need to watch what will happen next week. We'll really just close. It could still bounce from here. But previously, when we have a combination of some reversal pattern, as that one was an inverted cup handle pattern here, is we had a rising wedge, and it broke down that level, and we got that death cross. We got usually from the top 20% down, which is taking us from roughly 65 minus 20. I would basically get down to 53, 54 level. That's my short-term target for that move, but we could actually see lower price, so we see some acceleration and some other combination aligning in terms of the supply, as I was pointing out just before. Got another example here. I was back in 2019, divergence on the daily here. We got that cross 2050, and it did actually break lower. From the top was 66. Managed to actually drop to 51, so also about more than 20% down. And we've got another example back here in 2017, daily divergence as well here. That one didn't break that low, but still 55 down to the point to 43. That's also 20% drop. So that's what I'm expecting from here. And if we look a bit closer, of course we're having that daily divergence, but we're also having, together with that bear flag, and potentially more significantly, some quite clean head and shoulder pattern forming. Trying to draw that one. So here, just like this, and here we're just forming the second one. Sorry, it's too far. Just forming the second one here. And yes, that kind of figure, they're usually quite reliable, especially when you combine it with some divergence. So should we actually break that 57 level, and we'll be looking from that top to go down and trying to test the 50 support. So that's not necessarily what I'm trading short term. I probably like to close position on 54, because we'll see some buying pressure returning from here. But I think ultimately the target, it's also the 200 MA on the daily, that should bring some solid support to the price. But 50 is a potential, but 54 short term is probably more likely to be the lowest end for the short term trade. But potentially, should we see some sort of a combination of all I was pointing it here, it could definitely revisit 50. Lower for now, I think I doubt it, except if we see some major downturn or something else happening economically. 50 should be definitely buy zone. Actually, between 50 and 55 would be the place to actually start loading long positions, but still being careful, and we will need to see something actually reversing here, of course, on the technical side, but also on the fundamentals. So yeah, that's about it. So the plan definitely will be to keep shorting that market. Should we get any spike higher, and as long as we don't actually break above 61, we can still keep the bearish bias until we actually reach 54. Of course, we actually break higher than this, we could actually go for a double top 67 somewhere there. I doubt that will happen. I think it's a very low probability, but as always in trading, anything can happen, so I need to be prepared for that. But in any case, I'll stick to short position for now, and keep, of course, an eye for any sign that could actually prove that plan to be wrong. So yeah, thanks for watching that video, and I'll be covering natural gas also in a bit later tonight, and otherwise I'm trying to do another check midweek. Otherwise, I speak to you on the next weekend. Thanks for following me, and I speak to you soon. Cheers, bye.